What if the decades of diligent, disciplined saving you've been doing in your 20s, 30s, and 40s is actually building a massive, totally unavoidable tax liability? Especially for young adults aggressively building a nest egg right now. I mean, we've all been taught that putting money into a tax-deferred account like a 401k or a traditional IRA is the ultimate financial move to secure a wealthy tomorrow, right? But here's the catch. For successful savers, this exact strategy can actually create a systemic fiscal phenomenon known as the retirement tax bomb. You see, when you grab that front-end tax break on your 401k, you're essentially making the IRS a de facto co-owner of your wealth. They get a percentage of your total balance, and yes, that includes decades of compound growth, at a future tax rate that you simply cannot predict. It's literally like taking out a mortgage where the bank just gets to decide your interest rate 30 years from now. Crazy, right?
Section 1. The 401k tax bomb, the hidden liability growing inside your heavy iron bank vault. Let's get into it.
The actual detonator for this bomb is the RMD, or Required Minimum Distribution. Basically, starting at age 73, the government forces you to withdraw a specific percentage of your accounts every single year. You have absolutely no choice but to take this money out and pay taxes on it. This can completely disrupt your carefully planned retirement, whether you actually need that cash to live on or not.
Section 2. Anatomy of the blast. How RMDs trigger a chain reaction of wealth destruction.
Now, unmanaged RMDs trigger a totally brutal three-part domino effect. First off, your forced RMDs cause severe tax bracket creep, literally pushing your ordinary income right up into higher marginal tiers. Second, they trigger Medicare IRMAA surcharges. These are steep premium hikes based on your income from 2 years prior. And third, they launch what's called the Social Security tax torpedo, where suddenly, out of nowhere, up to 85% of your previously safe Social Security benefits become taxable.
So the absolutely crucial point here is that those IRMAA thresholds I just mentioned, they're cliffs, not gradients. Going just one single dollar over the modified adjusted gross income line costs you a brutal $1,148 penalty per person per year. No joke. If you aren't paying close attention, a tiny little RMD miscalculation can cost you thousands in hidden stealth taxes.
Moving right along to Section 3, the Defusal Playbook, taking control of the ticking fuse.
Think of your retirement account like a giant water cooler. You spent years filling it up tax-free while you were working. Well, when you retire, are you going to just chug the whole cooler at once? Obviously not. You drink it as needed. The whole goal here is that you want to control the flow, rather than letting the IRS force you to chug it all through those RMDs. To actually achieve this structural defusal, we follow 4 distinct phases. Phase 1 is the accumulation years, where you're aggressively diversifying your tax buckets. Phase 2 is the retirement gap, which honestly is the absolute sweet spot. Phase 3 is the RMD era, where we basically have to play defense. And finally, Phase 4 is legacy planning for your heirs. Let's really zero in on that incredible window of opportunity in Phase 2. When we put them side by side, it's so clear that using Roth conversion ladders during your gap years, meaning right after you retire but before those RMDs hit, is the ultimate wealth cheat code. You are legally and ethically taking total control of the timeline here. You deliberately shift money from your ticking pre-tax account over to your tax-free Roth account, paying taxes right now at much lower controlled rates. Once it is in the Roth, it grows tax-free forever and boom, 0 lifetime RMDs. You've completely neutralized the IRS's co-ownership of your money. All right, Section 4, Navigating New Tax Laws, How Secure 2.0 and the OBBBA Change the Game. Notice how the RMD age is totally a moving target now, thanks to Secure 2.0. It moved from 70.5 back in 2019 up to 73 today, and it's going to push all the way out to age 75 by the year 2033. What this means is that ambitious professionals now have an expanding yet still vital window of opportunity in their 60s to execute those Roth conversions before the government actually mandates withdrawals.
But what if you're already in the RMD era? Well, Qualified Charitable Distributions, or QCDs, are an absolutely massive defensive tool. In 2026, you can transfer up to $111,000 directly from your IRA to a charity. It satisfies your IMD completely, but and here's the absolute magic of this. It doesn't raise your adjusted gross income. This keeps you safely below those dangerous IRMAA cliffs we talked about and entirely prevents the Social Security tax torpedo. Plus, you can even use $55,000 of it to fund a charitable gift annuity that literally pays you an income stream.
Another really powerful tool authorized by Secure 2.0 is the QLAC, the Qualifying Longevity Annuity Contract. Get this.
You can now carve out up to $210,000 of your IRA, put it in a QLAC, and the IRS will completely ignore that money for RMD calculations for up to 15 years. You're effectively deferring that ticking fuse all the way until age 85.
Which brings us to Section 5, Securing a Wealthy Tomorrow, the structural tax resilience mindset.
Because guys, here is why this really matters. If you don't defuse this bomb yourself, you literally pass it directly to your heirs. Under current laws, non-spouse beneficiaries face what's called the 10-year trap. This forces them to rapidly liquidate inherited traditional accounts over a single decade. And this almost always hits right during their own peak earning years, subjecting your hard-earned legacy to the absolute highest possible tax brackets. Converting to a Roth is how you protect your family wealth across generations.
So you now have the playbook. You know the mechanics of the blast, you understand the power of Roth ladders, QCDs, and QLACs. The window of opportunity to defuse the 401k tax bomb is wide open right now. The only question left is, will you start taking control of your financial timeline today, or are you going to let the IRS pull the pin on your hard-earned wealth tomorrow?